Good afternoon, everyone. My name is Greg Boland, Chief Strategy Officer of Tiger Brokers. It's my great pleasure today to welcome Jamie Hanna, who's the Deputy Head of Investments and Capital Markets from VanEck. And today we're looking at exchange-traded funds and what they are, how they work, and the like. So as a background, over 818 billion of new funds flowed into ETFs in the first half of 2025, which is a huge number, pushing the total assets under management in exchange-traded funds globally to around 15 trillion. Today, we're very privileged, as I said, to have Jamie join us to give us a ETF 101 lesson and introduce us to the Australian-based product. So, Jamie, maybe you would like to just introduce yourself a little bit further, and then we'll kick off. Thank you.
Thanks very much, Greg. So as Greg indicated, I am the Deputy Head of Investments here at VanEck. So it's my responsibility to be running our ETFs, the trading, the portfolio management, ensuring that all of our ETFs do exactly as they say on the tin. So I'm responsible across all asset classes, from shares to bonds to commodity funds. So it covers a whole range of asset classes, and I was previously doing that in Europe more than 10 years ago as well, where I managed ETFs. And prior to that, I was working in index investment. So I'm fortunate enough to have spent a good part of 20 years working in something in a very similar field to ETFs.
Very good. Thank you. 20 years. You don't look old enough, Jamie.
Look, Zoom does wonders when you put filters on.
Very good. So maybe you can kick off and explain a little bit more about exchange-traded funds to start, and then and the like, and we'll look at your fund specifically maybe towards the end.
Thanks very much. So obviously, exchange-traded funds, this is a bit of an introduction for those who don't understand it. This is a good starting point, I think, for anyone wanting to know how to invest in them, what they represent. So obviously, there's always a disclaimer. This is not personal advice. I always have to say that, where this is just information. Alrighty, so who are VanEck? That's obviously a good starting point. Now, VanEck have been operating as a business since 1955. They were primarily at the start a US-based business, but over the past 20 years, they've really expanded into a global institution, and they are managing well over $100 billion US worth of assets globally. We have three main centers, one in New York, the other in Europe, the other in Australia. So between us all, VanEck is a global asset manager with a long history, and we're really one of the top, I guess, ETF issuers globally. In Australia, we launched the Australian business here in Australia in 2013. We started with no assets at the time, and we launched a range of ETFs. Since our original beginnings back in 2013, we now have 45 ETFs listed on the ASX, with nearly $25 billion worth of assets in Australia. So it's been a solid growth trajectory since we first launched our initial funds back in 2013, and now I think it's fair to say that we're one of the larger investment managers in the country. Look, I do hate posting awards until you win some and then you post them all over the internet. But I think the ETF industry has been very strong in Australia, and we're being beneficiaries of that as well as part of our hard work. Now, what am I going to cover today? That's the rough agenda. So really kicking off with ETF basics, running through passive and active ETFs, how to buy and sell them, and then really some extra questions and a case study. Now, let's talk about the ETF industry. Realistically, globally, it's extremely interesting. There are over $15 trillion now in exchange-traded funds and ETPs, and we'll cover what that actually means. But this number is huge. I mean, if you look back to 2007, the number was, insignificant compared to where it is now. So the growth that has been happening to VanEck within Australia is certainly similar going on globally. So there are, somewhere around, I think, nearly 14,000 ETFs listed globally. That number says close to that with 15 trillion. So this is a global phenomenon which has really been capturing a lot of new investor money within the market. In Australia, it isn't much different. I showed you some of the details. In Australia, there are around $280 billion under management in the ETF industry. There are around 400 ETFs listed in Australia now. So there's a good choice of ETFs. And I think since the start of the year, the industry has grown by about 22 billion. So, I mean, these are big numbers that are coming in to ETFs since the start of the year. And I think it's fair to say that by the end of this year, the ETF industry in Australia should be around $300 billion. So the growth in the ETF industry has really been phenomenal, not just in Australia, but on a global scale.
Okay, thank you. It's interesting. 1993, I attended an options symposium at the American Stock Exchange in New York, and they were listing the first ETF. And now we've got, how many did you say? 15,000?
Yeah, 14,000. Yeah.
Yeah, 14,000. So a huge growth industry since that time. So yeah. So in terms of background, in terms of ETFs themselves, sort of how do they work and how do they differ from managed funds, and are they really good for a beginner who's first in the market, etc. Those sort of questions, I suppose, what the audience would like to hear a bit about.
Yeah.
Jamie, if you've got time.
Absolutely. So why don't we just kick off with what is an ETF? And I think this is really, the crux of it. An ETF, it really is in the name. It's an exchange traded fund. So I think this is the key part, is that an ETF trades on a stock exchange. So in Australia, they trade on the ASX, right? So you can obviously go in and purchase an ETF like you would any other share. And that's really been the key differentiator between a normal unlisted fund and an ETF. Now, what are they though? Well, they're still a fund, and a fund is really a pool of money. So investors provide cash into a fund, and then that pooled money is then invested by a professional investment manager. So an ETF is really just a streamlined way of getting the investor money that they want to put into an investment into the hands of a professional manager. And so realistically, this new way of doing things in an ETF has proven to be, an efficient way. It's extremely low cost, and hence why we've seen such huge growth in the industry over the past, 10 to 15 years. Now, the real reason though is why use an ETF, right? And I think this is really the crux of where everything is. So we'll touch on some of the benefits, but I think the reason why people use ETFs, it gives you access in a single trade to a whole host of investment options. Sure, you can buy an ETF that has just Australian shares in it. You can probably buy Australian shares yourself quite easily. You might be able to buy international shares quite easily as well. However, in one trade, you can get access to a basket. So 50 or 100 Australian shares or 300 international shares across 20 different countries. You can invest in an ETF for a sustainable or an ESG metric. Or maybe you want income. So you're wanting to access equity income, or indeed just fixed income. That's bonds. Most retail people struggle to access bonds. So, or maybe you've got a view, maybe you think defense stocks are doing well right now, or infrastructure. So they're an easy tool to be able to buy an investment without having to buy all the underlying individual shares or bonds yourself. You can get it in one simple trade. And I think that's really why ETFs have been so successful and really have been taking a lot of new assets.
Yeah. And so how easy is it to buy and sell, and what are the sort of key benefits of these things?
Look, yeah, so I think what I've shown there is like some of the key benefits, but let's look at behind it, not the actual investment case. ETFs are extremely convenient, right? I think you get an instant exposure by buying an ETF listed on the exchange. They're flexible, so you can buy them through the ASX, and unlike a managed fund, the ASX has settlement periods of T+2, which means you will get your proceeds within 2 days, right? There's no form filling out. Once you have your broking account, you can buy and sell them once the ASX is open. One of the key factors with an ASX as well is that their fees have been typically lower. Now, that's mainly for passive ETFs, which I'll touch a bit more information on soon. But arguably, the cost effectiveness of them over time is a key driver. They obviously give you access, which is what I just touched on, and they're transparent. So there are daily disclosures for all passive ETFs where you can see exactly what is held in the portfolio, the pricing. So everything is completely looked through on a straight passive ETF. And that's really where a lot of the money actually is at the moment. So I think it's probably fair to kind of talk about how an ETF works. So when you buy the ETF on the ASX, for example, you go in and you buy an ETF, indirectly, the money flows through to us, the investment manager, and then we use those proceeds to go and buy the underlying shares or bonds or commodities which are in the ETF. Now, that's a fairly streamlined way of it working, but I think it's at this point key to really highlight there's two different types of ETFs. There is a passive ETF, and that tracks an index, and I'll go into that a bit more. And then there is an active ETF. And an active ETF is where an investment manager makes a buy and sell decision. And I'll touch on both of them. Now, the vast majority of assets globally have gone into a passive ETF. So a passive ETF tracks an index. And that is the key thing that a passive ETF does. So the vast majority of our ETFs, we have 45 listed in Australia, 42 of them are passive ETFs. And this means that we have an index provider who provides to us an independent file which shows the weights of each individual security in the ETF. So let's take, we all might have heard of the ASX 200, that's the S&P ASX 200. So it has CBA at 10.5, BHP at 8.3. So if we were tracking this index and we took in, say, $100 from investors, we would go and spend 10% of that money on CBA, 10% of that money on BHP, 10% of that, or 5% of that money on NAB. So we would match those index weights when we do the purchasing. So with a passive ETF, we physically replicate. So we go and buy the underlying shares or bonds or commodities that it might be, and then we put them and hold them in custody with a reputable custodian who holds the asset. So there are no, on a standard passive ETF, there generally aren't any derivatives or any other strange assets. We just receive your cash and then buy the index in the appropriate weights. And realistically, this has been, I guess, one of the smoothest flow areas in terms of ETFs on why they've been attracting flows. But I think it's fair to say that most ETFs track a market cap weighted index. And this is really where we need to start thinking about this. So we said things are passive, right? Passive is still an interpretive term because we need to understand what an index is. So the market cap weighted index means that the market cap, now that is the size of the company. So whatever company it is, if its value is $10 billion, then that's how you compare it to another company. So most assets in the world in terms of passive indices are in this market capitalization weighted index. Now, let's have a quick look at it because I want to explain more because this is kind of a key point. So if we look at, the ASX 200, as I've shown just in a couple of slides ago, the bigger the company, the bigger the weight in that index. So if we take the top 10 holdings, they make up nearly 50% of the ASX 200. Now, this type of, I guess, approach is one method of doing an index. So I want to give a bit of a history here because The very first index that was ever invented was the Dow Jones. Now, a lot of people might have heard that term, the Dow Jones Index. It's a US index which was set in the developed in the late 1800s. And that was well before computers. So people weighted each company based on the share price, right? But everyone, after using this particular type of index for decades, people said, well, why is share price a good driver for an index, right? So then by the time the 1940s and 50s rolled around, people said, well, maybe the size of the company should be the reason for the weight. Now, obviously, the size of a company doesn't necessarily result in the best performance metrics. As you can see in this table, just because CBA is the biggest or BHP is the second biggest doesn't mean that they're going to be the top performers. If we actually look at the top performers for 2025, you'll see that it was some smaller companies, some Regis Resources, Genesis, Sigma Healthcare. So what it's actually saying, though, is that maybe there's more to this index. And this is where we really need to think about it, right? This is where ETFs stand apart. The market cap weighted index is one type, and I've given a little bit of an overview. That's how the S&P ASX 200 works, the S&P 500, the FTSE 100, some ones that you might have heard about. But there's all different types of ways of doing an index. There is a simple method called equal weighted, where you would actually, rather than taking the size of a company, you will equally weight all these shares in a company, for example, so that BHP has the same weight as a smaller company, maybe something like Woolworths, which is still quite large, or same size as NIB. So that's an equal weighting approach. But then there's also a factor-based approach, and that's something where you can add actual mathematical principles into the underlying index. So it can go and do things like assessing earnings per share, or the debt each company has, or whether or not it's a quality factor or a value factor. So we can run these mathematical models, or there's a straight thematic where you might want to buy a global esports and gaming ETF or a defense ETF or gold miners. Now, this is what you need to understand, is that we, even though all of these are different types of index, we don't make the decision. We, as the underlying manager of this, we don't say, right, I think BHP is a good buy right now. I think we should buy more of it. Whatever the index tells us to do, we essentially follow what it says. So if it says, the weight of BHP needs to go up, we will buy more BHP. We are not making decisions based on the underlying fundamentals. The factor-based ETFs will value things based on the underlying, company financials, but it's all driven by a model on the back, and there is no individual bias. We are not saying this is a good buy, this is a good sell, this individual company should come in. And that's what passive is all about. Even though we have different types of passive index, we are not making individual decisions on how the money should be deployed. But that's what active ETFs are. Now, they're more of a growing sector. So more recently, there are, more active ETFs coming to market. As in, they operate as an ETF, and generally most of them are listed as an active ETF in their title. But these ETFs will have a portfolio manager who will do their own analysis. And if they think BHP or Woolworths is a good buy, they will invest the money based on their analysis. They won't use a straight index, which a passive will. They will go and invest based on their investment team's philosophies and their valuation metrics and whatever their investment policy dictates. So they will make active decisions to upweight or downweight constituents in the fund, and hence they're called active. Now, the big problem with active, and this is really why most funds in the ETF sector have grown so much, but most have gone into passive, is that if we actually look over the last 20 years, using what's called a SPIVA scorecard, this is where the S&P go and rate the performance of active managers against an index such as the S&P ASX 200, that if we look there, you'll see that over 10 years, 82% of active fund managers underperform the broader ASX 200. And what that actually means is that over an extended period of time, active generally underperforms, yet active generally charge higher fees. So not only are you paying higher fees, but you're actually underperforming the index over a longer period of time. And when I say longer, we're only talking 3/4 are underperforming over 3 years. And it really just ticks up, to 82% over 10. On a 1-year basis, some funds can have a good year, some can have a bad year against the index, and it's closer to 50% underperforming. But over any longer time period, the odds are kind of stacked against active managers actually outperforming. Now, that is absolutely not me saying here you should not buy active, because we have active ETFs, not just passive. It just means you need to be more selective in your active and what the underlying active manager is trying to achieve. Because if that active manager might just track what's called like a quality factor or a value factor, you can easily get that exposure direct through an ETF for probably a much cheaper fee. And hence, a lot of the more factor-based ETFs have really taken money away from a lot of the active ETF providers out there, because they're offering similar returns, or if not better than some of the market cap returns over a long period of time. So this has been the challenge of active ETFs. And this is where I personally think passive have picked up a lot of the money, but active managers, some will still outperform. You can see there that over 10 years, there is still nearly 18%. It's just identifying that 18%, which are the strong performers, is always, the relative skill in being able to, produce that outperformance.
Jamie, if I could just interrupt there, we've got a couple of questions, if you would. So just the second, we'll start with the second one first. So in terms of, we talked here about active and passive. So what are the key differences in the volatility between the ETF passive and the active strategies in the Australian market?
So there is always a difference. However, it depends on the index which is underlying the passive fund. If you are buying the S&P ASX 200, then it's a relatively low volatility index, right? It's not taking any great risks. It's generally broad-based across the whole market, and it's a reasonable representation of Australia. So if you buy an active, then they might take extreme risks against the ASX. They might buy considerably different shares to what's in the ASX 200 in different weights, and hence they'll get a different outcome. Generally speaking, the index would be less volatile. However, you can buy more high-risk passive ETFs, which might actually target some factor which might be slightly more volatile. So you can get volatile ETFs, but if you're buying a broad-based general market ETF, it will generally be less volatile than an active manager who's picking funds. There's lots of exceptions to that, but by and large, it is less volatile.
Okay, cool. And then so the first question, which I asked, was asking second, but that's because it's looking backwards in terms of the passive. So the passive ETFs, how frequently do they rebalance? Do they do it? So you're getting an index each day. Are you rebalancing it every day, every week, every month? And that's to reflect the index changes, obviously, and obviously there's reweightings every quarter or whatever it might be. And does this introduce any sort of hidden cost or tracking error in that you don't do it continuously, or you do it on an interim basis?
Yep, it's a good question. So passive ETFs that track an index will have a rebalance schedule. Most ETFs will either rebalance quarterly or semi-annual, so twice a year. That means that the index, we receive an index file every day, but if we're already holding the underlying shares that are in that index, it will just track that index. And that is called tracking. It is how close the fund's valuation is to the underlying index. And generally speaking, it's nearly identical in most ETFs, right? It's really only the value of fees coming off that really affect that. So this rebalance frequency, which is quarterly or semi-annual, means that we will assess, or the index provider, I should say, will assess the companies, for example, that need to come in or out of the index. And if it's on a quarterly basis, it means that every quarter we will rebalance and take in companies that are, due to come into the index and sell out. So yes, turnover will go up on a rebalance day. And when we trade the underlying shares or bonds, like anyone like yourself who's buying shares or bonds, there is commissions. We have to pay brokerage as well, similar to you. However, the amount of brokerage we pay is fractional, if not zero. We pretty much pay, I guess, at times zero, and hence the cost imposed for taking one share out and putting another one in, the cost to the end investor are quite minimal these days. If you went back 10 or 15 years, then the costs were considerably higher to do a rebalance, and we used to get a lot of questions about that. But now the cost for us to execute the rebalance trades are very low. But yes, there can be costs associated with doing the rebalance, hence why they're only quarterly or semi-annual in most cases.
Okay, so and just in terms of rebalancing, you're talking about quarterly. What about ad hoc ones? So if we think of the S&P 500, there's been a couple of stocks drop out in July and a couple added, like Trade Desk was added. How do you handle that sort of thing in terms of an ad hoc situation where a company that's in the index gets taken over or it goes private or whatever, and therefore falls outside the index, and then you have to go and buy another stock to go into the index?
Yep. So that type of activity is taking place all the time, and that's called a corporate action, is what we would call it. That's where a company might be taken over. There might be a capital raising by a company. There might be a merger. The list is kind of endless. When those scenarios happen, the index provider has a set of rules for each in terms of how they treat it. So if there is a takeover of a company, the index rule might say, okay, that company will come out of the index and we will find the next best suitable candidate. So in that scenario, we would essentially remove that stock because it's been taken over and put in a new constituent. So these types of corporate actions are something that we analyze daily. It's something that we, as the portfolio managers, have to know exactly what we're doing. And then the index provider has a rules-based approach to how they treat it. So we can't have a company in the index which is no longer in existence. So as you said, if it's taken over, then we have to put a new one in. But each ETF and how they treat it is slightly different. But arguably, yes, any of those types of corporate activity, we will need to trade the portfolio for. However, while I said there's a lot of them, there's a lot because we're holding more than 2,000 shares across 60 countries. There's always something going on, but it might not have a big impact on the fund at all because it might be an extremely small weight in the fund, and hence most investors wouldn't notice it. However, if you had a takeover of Commonwealth Bank in Australia, or BHP, or Apple was taken over, those types of big corporate actions would be noticeable in the index.
Okay. And then just in terms of buying and selling these things, ETFs, we all sort of say we're a newbie to this. When do we buy and when do we sell? What's the best buying and selling time?
Yep. I think, I have a slide on this actually. Let's think about buying and selling ETFs. Buying and selling ETFs is exactly like buying a share through your broker, like through Tiger. So I think it's fair to say that an ETF operates similar to a share, but we, as the ETF issuer, employ market makers. Now, I don't want to implement new terms, but they will put quotes on the exchange so that you, as the investor, can buy and sell the ETF units that you hold at a fair price, right? And hence, the market maker is providing liquidity so that you can buy and sell throughout the trading day. Now, there are still a few key things that you need to understand. The ASX, right, and this is an ASX thing, it doesn't really occur in many other markets. It opens at 10 o'clock and closes at 4. But that's not really true, because the ASX opens in alphabetical order from A to Z, from 10 o'clock to about 10:10. So at 10 o'clock, A and Z will be open, but Westpac won't open until nearer to about 10:10 a.m. Hence, the market maker who is valuing the ETF live and ensuring that it stays close to its fair value doesn't have all the information until the market is fully open. Hence, you really need to wait till about 10:15 before you start buying or selling an ETF on the ASX, because you need to give time for the market to fully open so that prices can be more accurate. And the same thing goes for the close. So the ASX doesn't just close at 4 p.m. It stops trading normally at 4 p.m., but around 4:10, it has a closing price auction. And it's a one-off snap, which is an immediate price, and that's where the close price for the day comes. And in this closing auction, it's extremely important that you don't try and trade an ETF in that, because like that open, which is staggered, the market maker can't accurately value the ETF because everything in the whole market is valuing in an instantaneous snap. So it's always good to avoid trading in the closing auction. Now, some other things you need to think about. ETFs cover all different aspects of the market. Some of them might be US shares, some of them might be Chinese shares, for example, that the ETF might hold nothing but Chinese securities. Now, China has holidays. So, for example, China has holidays a number of times a year that are a week long. During that time, it's extremely difficult for the market maker to price a China ETF. They still do, but we would suggest that you wouldn't buy that ETF during that week, because whilst it is trading on the ASX, the market maker is using their best methods to work out where the price is, but the underlying Chinese market's closed for a week. So it makes it more difficult. Finally, there's one thing, and it's not listed on this sheet here, is that I'd always suggest trading at a limit price. Now, when you buy and sell shares or ETFs, you can put in a market order whereby you will take the best bid or the best ask that's sitting on the exchange, and you will fill at whatever is the best price. The alternate to that is that you use a limit order. And for ETFs that move around during the day, I would suggest putting in a limit order so that you don't pay too much when you're buying, or you don't sell for too little when you're selling. While the market makers provide a fair price at all times, it's still good practice to place limit orders when trading ETFs. So I think these key things are there. Don't trade in the first 15 minutes, avoid trading in the close, look at what the underlying assets are, and if they're open or closed, and finally place limit orders. They're my key tips for buying and selling ETFs.
Cool, thank you.
Now, Greg, I know I think there's probably one thing I probably didn't touch on, and it's really just understanding the ETF. And while I'm saying, you have to look into the ETF and understand how it works and all the like, I think it's key and fair to say that each ETF product issuer has a website, and the website will show all the information that you need to understand the product. So it will have the price, it will have the management fee, it will have all the securities, and it will list them. It will show any dividends. It will show everything that you need to know when investing in the ETF. And by law, a lot of this information has to be provided, and you'll find it on any of the ETF product pages which come up. So don't hesitate to look through the website. And obviously I need to say this, but we have a PDS, product disclosure statement, and a TMD, which are key information documents for anyone looking to invest in any ETFs.
Okay. Just in terms of, I've got a couple more questions, if I may. So the first one is, in a globally diversified portfolio of ETFs, what proportion should you be allocating to Australia? So you just go by, the weighting of Australia compared to the rest, or what would you do, or what would you say to a newbie who says, okay, I've got $10,000, I want to invest in 10 ETFs or 5 ETFs. What sort of proportion would you put into Australia?
Look, this is the $1 million question. To be honest, this is about asset allocation.
Okay.
So, look, I cannot provide personal advice here, but it's always good to be well diversified. Okay, and that means if you're actually building a diversified portfolio, you're Australian, then you want some exposure to the Australian Stock Exchange. But then you also need exposure to international exchanges as well as a mix of bonds and other types of investments, so that you get a well-diversified portfolio. So if you're looking at a well-diversified Australian ETF, it's debatable because it depends on what type of, risk profile you have. If you're in the retirement phase, if you're a young person with 40 years to retirement, you've got a long-term horizon on your investment. Generally speaking, if you're an Australian, you would expect to have at least 20% in, Australian broad-based equities. That would probably be a minimum for Australians. That said, some people might go up to as much as 50%, depending on their risk profile. So Australia is only 1% of the global market. So we are a tiny little drop in the global financial pool. However, if you're an Australian and you live in Australia, it is considerably more important to you than it is to an American investor. Hence, usually you want exposure to your local market. But if the US falls, generally Australia falls. So there's not a huge diversifier between a lot of international US equities and the like in Australia. So when you're mixing some Australian, ETFs with international ETFs, it's good to have a mix. But generally speaking, as an Australian, it would be 20% minimum.
Thank you. There's also a sort of a specific question around a specific ETF. So how does VanEck's MVR ETF manage volatility swings amid commodity price swings, if you like?
Yep. So MVR is our Australian Resources ETF, and it holds Australian resources, big miners, BHP, Rio Tinto. It doesn't aim to, stop volatility, because it can't. It just holds the big miners and mid-cap miners. Where it differentiates itself is that it caps the exposure to the big miners. So BHP, for example, if you're talking on a market capitalization weighted index, will be a very large percent of a resources index. We've capped its exposure, and hence, rather than getting 30 or 40% of the fund in BHP, we've capped it at a far lower level. Hence, you're getting a broader based exposure to the Australian resources sector without getting too much in one big company. Does it avoid volatility? It's not designed to avoid volatility. It's designed to just, share the resources investment across more resource companies than being overweight BHP.
Okay, cool. Thank you. In terms of other things like, you're a first-time investor, what are the sort of the tax implications? Do you know much about that? Or I suppose that you can't give tax advice because you're not a tax accountant, but what sort of things generally should people take into account in terms of tax?
Yeah, absolutely. I cannot provide tax advice. Everyone's personal circumstances are different, and you'll need to speak to your financial advisor. So that out of the way, ETFs generally, if you're an Australian citizen, they have a number of ways that they're taxed. Like buying a share, if you buy a share or an ETF for $100 and you sell it for $200, you've made $100 worth of capital gain, right? And you can be taxed on that. Generally speaking, if you hold it for more than a year, you'll lower your capital gains tax obligation. But any profit you make on buying or selling the ETF is taxable, and any losses can offset that. That's the same as any share, and an ETF is very similar. Where ETFs differ to an underlying share is that every year you will get a tax statement, an AMA or end of year tax statement, which will be sent out by the issuer, and it will detail any capital gains that are attributable to the fund. So within the fund, we are buying and selling shares and bonds and everything like that during the year. We're also paying dividends. So all of this stuff needs to go into your end of year tax return. And so the end of year tax statement needs to come out to you as an investor. And if you're doing your tax return yourself, it explains where each part needs to go into your tax return, or alternatively, your accountant will have the details and they can help produce your tax return. So the capital gains, which are within the fund, can go into your end of year tax return, even if you haven't sold any of the underlying ETFs. Hence, there is always tax in Australia. In most countries, there's always tax. So you really need to speak to an accountant. However, any profits, generally speaking, are taxable in ETFs.
Thank you. I think you've got a case study maybe to help conclude the session, if you'd like to share that with us.
Yeah, look, I appreciate that.
If you've got time.
No, I'm happy to. And it's about really what I've already touched on, and it's about Australian core equities. And this is really what I was showing you before. Here is the ASX 200 on the left-hand side of that column, and you can see Commonwealth Bank and BHP and NAB and all these big companies make up a really large percent. And as I showed before, nearly 50% of the ASX 200 is made up from the top 10 companies. So it means the other 190 are hardly making up much of the performance at all. So we kind of went away and developed the MVW ETF in Australia. And I think it's fair to say that we don't overweight each individual company. So we're not basing it on the size of the company. Hence, the Commonwealth Bank has the same weight as Santos or Cochlear or Macquarie. And so all of the large companies are down-weighted, but it also then upweights some of the smaller companies to be the same weight. So they're all equally weighted. Now, there's a large volume of academic research on this, right? And people have looked at this type of research for periods of more than 50 years. And I know that the CSIRO and Monash have actually done quite a large study on it as well. And generally speaking, what some of the research has found is that over the longer term, equal weighting can outperform. Because what it does is it gives a slightly higher exposure to smaller companies rather than the really big ones. And hence, a lot of these smaller companies are kind of like more value-adding stocks, as in that they have been shown to be able to grow at a faster rate than some of the really large companies. And also by equally weighting, it adds some market timing. It means that we're really adding to returns, adding to an individual company when it falls and selling the companies that are doing well, so that each rebalance, we're bringing it back to an equal weight position. And over the long term, that has a bit of an outperformance metric to it. So we launched MVW in Australia, the Australian Equal Weight, way back in March 2014. And since that date, it has outperformed, right? So we're talking more than 10 years performance here. It has shown what we thought it would do. What the academic research has shown is that it has outperformed the ASX 200. And one of the other things as it does is it gives a more broader based exposure to the ASX, right? So as you saw, the top 10 companies in the S&P ASX 200 make up nearly 50%. So that means that if something happens within one of those 10 companies, it will have a really large adverse impact on that index. So When would MVW not do well? Well, if BHP and CBA just rally through the roof, then it would underperform. But arguably, the ASX is not just a collection of the top 10 companies. It's a lot more companies than that, and hence MVW, gives a broader based exposure to the Australian market, which is arguably just overweight some big, I guess, mining and banking companies. So, Greg, I don't know if you have any other questions, but I've just put up there an ETF checklist that just covers some of the things that I discussed earlier. Obviously speak to your financial advisor, ensure you're buying from reputable ETF providers, and really do your research, right? You do need to research an ETF just as much as you do any other company that you look to invest in.
Thank you. Thanks very much, Jamie. And there's no further questions at this stage. So just to conclude, we greatly appreciate the time and effort you've put into your presentation today and sharing with us key insights into the ETF market and how that's developing and how you are adding further products depending on passive and active and the various sectors, etc. So now 45, 46 ETFs.
Yes. Yes.
Okay, and all of these are available on the Target Trade app. So if you're a Target Trade client, then you can then type in the particular code that you wish to look at. It has got some details around each ETF, but if you want more details and the product disclosure, etc., then you should look at the VanEck website to clearly understand what exposure you're getting and what the product is actually trying to do in terms of replicating an index, getting exposure to the mining sector, either in the underlying shares or different commodities or bonds, as the case may be, as well as getting exposure to international markets. So, Jamie, just on behalf of all of our clients and the staff and of Target Brokers, would really appreciate your time today, and thank you very much for joining us. Any other following thoughts or ending thoughts at all?
No, look, I think ETFs are certainly something that people should keep on their radar. They certainly are a good investment for most people looking to diversify their portfolios.
Well, thank you very much, which we think is a very important trait, rather than trading just one particular stock or one index, etc., is to diversify across a range of products. So that you get a diversified exposure to markets. So really appreciate your time and thank you very much for joining us today.
Thank you.